Hey gang, the market was rough last week. It lost about 5.5% in 5 sessions. It doesn't happen very often. We received several emails and questions asking us about this week. I'm gonna do a little lab tutorial for you to show you the put to call ratio and show you some indexes to show you how the market's looking. I'm doing this video to show you how I gauge fear in the market. Last week wasn't pretty. As I mentioned, the stock market lost more than 5%. But what we have to do, aside from looking at price, is to look at market internals. Market internals is a way to look at the market from a different perspective. When you look at price, you're looking at one perspective, but when you're looking at market internals, you're seeing something else. So it's a different view of the market action from the inside out, and it's very important. What we're going to look at today is the total put to call ratio. This is the volume of all the puts divided by the total number of open calls. As you could see here, here's the total put volume, and here's the total call volume. And if you divide the put volume by the call volume, you'll get this number, 1.14. Why is this important? Why is it relevant? Why are we talking about this? Well, here's the thing. This is a contrary indicator. When markets are in panic mode, as they were last week, many investors began buying puts. When the ratio of puts to call gets above 1, it's telling us that the market's near a tipping point. Anything above 110 is considered a tipping point and is telling us the market is oversold. It's a contrary gauge of market action, if you will. I'm going to show you a chart that'll show you more details in a second. What you're looking at is a daily chart of the put to call ratio, as I just explained to you. We were looking at the CBOE exchange, now we're looking at stock charts. And this simply represents the daily graph of the put to call ratio. And as you can see, once you get past the 110 level on the upside, we tend to go the other way. Thursday, we went up to 130, which is pretty high. As you could see here, since May of this year, the highest we've gone to is just a little bit above 130, and as soon as that happens, we revert back. On Thursday, we went to 130, and now we're at 114, and it looks like we're going to be coming back to the average. What this is telling us is that fear levels are coming down, that the level of put to call is coming back to neutral territory, and when that happens, markets stabilize and become bullish once again. So we use this as a contrary indicator. When you see the level of put buying get out of control or above the the ratio gets above the 110, 115, 120 level, it's telling us the market is overdone. And we've seen it happen here around the June area when the market came down a bit and then they snapped back up. And we're seeing it again right now. The markets are slightly above the 200-day moving average, which is positive, and the put to call ratio is coming back down to neutral. And that's telling us the level of fear in the market is lessening. That means more bullish price action for the stock market. Hey gang, if you enjoyed this video, please let us know. We want to hear from you. We want to know what you're thinking. These feedbacks help us make these videos better. Roger at wealthpress.com. You have a wonderful weekend.